Welcome to this episode of the Hidden Money Podcast. We are doing episode 4 of our real estate series, and today we're going to be covering cost segs and purchase price allocations. Now, I know we've drilled cost segregations into the ground on this podcast because it is a tremendous tax benefit. We have not covered purchase price allocation, so if this is a new term for you, stick around because we're going to have some really cool real estate tax strategies.
Really cool tax strategies. I mean, it doesn't get much better than this in real estate.
Yeah, but first, let's just lay the groundwork on kind of our past episodes. Short-term real estate, long-term real estate. The whole goal is, when you buy real estate, it defaults to passive, and we're going to try to move those passive properties to active because most of the time our clients have an active tax problem. They're W-2 or self-employed income. So why do I want to move it from passive to active? Well, we're going to drive a bunch of loss in these rental properties that we're purchasing.
Tax loss, not cash.
Tax loss. And we're going to offset our W-2 and our self-employed income with this tax loss we're doing. And the tax loss is mainly generated, not only, but mainly generated through cost segregation. This is where we're going to start explaining what a cost seg is. So, Mike, take it away. What is a cost seg?
Well,
the buzzword.
Cost seg. It sounds very smart, right? But everyone uses it. Most people don't know what it means. I'm going to get out of the real estate world just for purposes of illustration to try to make this make sense. The tax law says that anytime you buy an asset that's going to be used in a trade or business and it has a useful life of more than 1 year, you're not allowed to deduct it. You're supposed to capitalize it. Capitalize it means you don't take the whole expense right then and there. You actually put an asset on your balance sheet and you take some expense over the useful life of the asset. For example, let's say I'm a taxi cab driver. I go and I buy a $10,000 taxi. Under normal rules, we're going to get to bonus depreciation in a second, but under normal rules, I can't just go expense that $10,000. I have to, the IRS says a vehicle has a useful life of 5 years. So I have to take that $10,000 that I just spent. I don't get to deduct it on my tax return. I have to put it on the balance sheet. I have a $10,000 taxi cab. And then over the next 5 years, I get to depreciate it. Now, this isn't exactly how it works, but we're going to roll with this for purposes of the illustration. You would basically get $2,000 a year for 5 years, and then you would recover your entire cost of the taxi cab. In real estate, you're also buying an asset that's going to be used for a trade or business, not if it's just an investment property, but if you're buying a piece of property that you're going to rent or use as a trade or business, you're required to capitalize it. You don't just get to deduct it. So when you go buy, let's just say, a single family long-term rental, the IRS says that house has a useful life. It's residential real property. Different for short-term rental, but if it's a long-term rental, it's residential real property, and that house has a useful life of 27 and a half years. And this drives me crazy whenever we get clients that have these rental houses and they're just being depreciated straight line over 227 and a half years. That's not as beneficial as it could be when you consider the time value of money and the power of tax deductions. The IRS actually says in the Internal Revenue Code, it says I'm not supposed to depreciate that whole house over 27 and a half years. It says I'm supposed to depreciate the structure, the building, the roof, the foundation, the sticks that are holding it up, and the siding over 27 and a half years. It says if I bought it and it had a flooring in there, or appliances in there, or countertops, or cabinetry, which they all have, those have shorter useful lives. And the IRS laws under the depreciation part of the tax code says you're supposed to depreciate those over 5 years or 7 years. Or my driveway, I'm supposed to depreciate over 15 years. The IRS says you're supposed to depreciate that. You're actually not following tax law if you depreciate the whole thing for 27 and a half years. I've never seen anyone get hit by the IRS for that, though. They don't care because you're not taking as much deductions as you could take. The IRS doesn't seem to mind that. They just mind when you take more deductions than you're allowed. So you go buy a house, you pay $1 million for it. That sales contract you have that your realtor put together for you does not break out how much you paid for the flooring, the appliances, the countertops, the lighting fixtures, the driveway. It just says you bought a house. And most lazy CPAs go put that 27 and a half year asset, or if it's short-term rental, 39 year asset. How do you know how much you can depreciate faster? Well, you have to get something called a cost segregation study. And that's what they do. They take your cost and they segregate it using IRS prescribed methods. They segregate it out into these different components. And why do we care about segregating them out to these components, Kevin?
Well, the more we can push out of the 39-year or 27-year life into 5, 7, 15, or 20-year life, then it's eligible for bonus depreciation, which is the one big beautiful bill act put into place in July. So any cost, so on this $1 million property, an engineer would actually perform a study, and you're going to get a report that's going to actually detail out and value those assets inside of that house. And let's say there's a pool and personal property and countertops and flooring that's eligible for bonus. It's going to be in this report, and your CPA takes this report and says, of this $1 million house, $300,000 of it is allocated to 5, 7, and 15-year class life. So what does the CPA do with that? Well, thanks to the One Big Beautiful Bill Act, I can expense, bonus depreciate that $300,000 in 1 year. Not over its useful life of 39 years or 27 and a half years. You're getting a $300,000 immediate write-off because we've segregated the costs out of the structure into different class lives.
Really quick though, it's just accelerating 27 and a half or 39 years worth of deductions into the first year, which means you're actually going to have less depreciation deduction for the next 26 and a half or 38 years.
That's correct.
So understand, this is a one-time deal. Why would you want to do that? It's called the time value of money. Would you rather keep more money in your pocket today or get a little bit from the government over the next 27 or 39 years? Think about it. Having that money work for you instead of disappearing with the federal government is a big deal. You're deferring your taxes. It makes a big difference as you grow your portfolio. So that's cost segregation.
Yeah, and there it always bites on the back end because
not always,
but generally speaking, let's just say you write off $300,000 of this $1 million house. Let's say that $300,000 saved you $100,000 in tax. So you had $100,000 come back to you in withholding, or you did not remit $100,000 to the government if you're self-employed. So you saved $100,000. What are we doing with that $100,000 that we either got refunded or we're going to pay to the government? We're going to invest that and grow it. Because when we sell this rental property, and this is oversimplifying it, but let's just go with this. When we sell that rental property in year 5 or year 10, we're going to pay back that tax savings we got. We're going to pay it back in 10 years. But if you've invested it and done what you should have done on the start and invested that 100, maybe you grew that 100 to 200 or 300. Okay, in year 10, I'll pay the government $100K. I'll pay them their tax savings back, but I've got an interest-free loan from the government. The tables have turned. You are getting money from the government to invest that you're going to pay them back interest-free in the year of sale. And even in the year of sale, you can mitigate the tax and depreciation recapture if you're smart.
You absolutely can mitigate it, and you should mitigate it, and that's why proactive, constant tax planning and tax strategies are so important. If you're going to buy a property and you know you're going to sell it next year, maybe you don't want to cost.
You can run the numbers. I think we teeter-totter back and forth, and depending on the client, if it makes sense to cost seg then sell. I mean, how much margin are we talking? Is your income up or down? Because your depreciation recapture is typically at ordinary tax rates, and if your ordinary tax rate's low, then you could be paying less depreciation recapture, but there is some depreciation recapture that is subject to 25% flat tax rate. So.
Yes.
It's all part of the strategy. Every situation is different. You have to speak to a professional before doing any of this because we can only give broad advice on the podcast because we don't know you.
And just so you know, we didn't have bonus depreciation before 9/11. Actually, it was in 2002 that we had our first year of bonus depreciation. But we were doing cost segs before then. Why? Because people would go out and buy these rental properties or an apartment complex, not know anything about it. Their CPAs did not educate their clients. They weren't advocates for them. And they were depreciating these things over 27 and a half years. Well, it turns out most of what you cost segregate out in a cost segregation, in Kevin's example, if you get $300,000 on $1 million house segregated out, most of that is actually going to come out as 5-year assets. Well, let's say bonus depreciation doesn't exist today. I bought this property 5 years ago, 6 years ago. I didn't know about cost segregations. And now it's year 6 and I'm in a high tax year and somehow I could use that depreciation. Well, because you were supposed to segregate it out in the beginning, the IRS gives you an automatic way to recoup that, to change your accounting method. It's called changing your accounting method from an impermissible method to a permissible method. That's an auto change. You go through that. And we've done that. We did that so many times. Not so much now with bonus depreciation, because more people know about cost segs now. But if I was in year 6 and I had just taken my normal 27.5-year depreciation, I could do that cost seg, do a change in accounting principle, and get that 5 years of depreciation I should have gotten back that year right then. So you don't have to do a cost seg in the year that you place it in business. As a matter of fact, in some cases, you shouldn't do it in the year that you actually buy the asset. You should do it with a big overall encompassing tax strategy. When does it make the most sense? If you're going to materially participate in 2 years, but not in the first year, cost seg in the second year.
Or if you're going to RSUs, restricted stock units are a big thing as if you're working for a software company or something. You're like, hey, I'm going to have some vesting, or I'm going to have some big income hit next tax year. This year I'm kind of light, but I bought a rental property, or I have this rental property asset sitting here. We're going to plan to cost segregate and accelerate those expenses in the year that your income's higher, because we can eat up more of that 37% bracket.
Yeah, and please understand, Kevin and I are talking generally speaking. I have seen so many different circumstances with different clients that have different facts and circumstances where it makes sense to cost seg 3 properties in 1 year. Another one where it makes sense to not cost seg any. Sometimes you do 1 a year. It just depends. Sometimes we want to cost seg when they're passive because we need passive losses. There's a lot of details that go into making the decision when to cost seg. But generally, there's always a time to cost seg.
Yeah, and I want you to get into PPAs, but I just want one more caveat because we're super excited about purchase price allocation.
Oh, heck yeah.
And we'll explain that. But in cost segs, you have to get a qualified engineer. I can't stress this enough, is because the IRS is going after those DIY cost segs. If you Google cost segregation, you're going to probably come along some websites that say, do it yourself. You put in the property value, put in the address, and it's going to give you an allocation of assets.
We answer some questions. And they even say they provide audit defense. And it costs $500 or $600, where it might cost $3,000 or $5,000
or even $100
for an engineer. Yeah.
Don't do it. The IRS is aware of those, and typically we remit on the tax return. We put the cost seg. We show our work. We're like, here you go, IRS. Here's our new permissible depreciation method. Here's our substantiation for it. We show our work because we're not scared of anything.
We're not supposed to do that. They don't ask you to attach it, but we do.
But our audit
anyways.
rates are low.
We get low audit rates.
But if you find out that you've been doing these DIYs and the IRS gets their teeth in it, it's going to be hard to claw out. Now we're helping a client do this exact same thing. We're trying to re-engineer this DIY cost seg with an actual engineering study. And we do all this work in-house. We got an engineer on our team in-house that we perform engineering studies. So he's qualified, been doing it with us for at least six years plus.
Yep, in the case that Kevin's alluding to, we're using our engineer to defend a cost seg that he didn't do, and it's not going as well as it should be. I mean, it's going well.
It's going better than what the original call was.
But I wish they would have just come to us in the first place, but they didn't. One other thing I just want to, I hear this false assertion made all the time. Unless my house or property is worth more than $1 million or $2 million, cost segs are not worth it. I hear that all the time. Yeah. It's baloney. Yes, if you're going to go to the big national firms that charge $25,000 for a cost seg, you don't want to get a $100,000 house cost seg. But we see clients with $100,000 properties, even one with $80,000 property, that benefited greatly by doing a cost segregation study. So don't think it has to be some huge expensive property. And if you're hearing someone say that, they're wrong. Sorry.
Yeah, they are.
Empirically wrong.
Yep. So that's the foundation of how real estate taxation can really drive losses, cost segregation. It's a very good strategy that you, as the owner of the property, are 100% in control of, whether you can do it or not. Paying more tax than you're legally obligated to pay is a crime. And here at Revo Taxpayer Advocacy, we are here to fight for you. We want to make sure that you don't pay that dollar more in tax than you're legally obligated. Mike and I want to meet with you personally. And if you go to our website, revotaxpayer.com, and you click the button Schedule a Consultation, we want to offer a free consultation for you where we talk about your situation and get to know you, and then we can advise the best next step. So it doesn't matter what's happened in the past. You can change your facts today and have a better tax outcome in the future. So revotaxpayer.com, we'd love to hear from you. All right, back to the episode. Now, let's pivot into purchase price allocations.
Yes.
So purchase price allocations is you take a cost seg and you get a needle of steroids and you inject the cost seg with steroids, and all of a sudden now we have a purchase price allocation. Same method, same thought process, accelerating depreciation. The difference is you're not going to be in control of this as much because a buyer and a seller are going to have to agree on this allocation before closing on the property, before contracts are signed. So there's a degree of unpredictability of doing this, but when the stars align and it works,
oh, it's beautiful.
It is beautiful. So let's get into purchase price allocating, what it is.
Yeah. Before I get into the nuts and bolts, we have a client 2 months ago, like normally in a cost segregation example, you're going to get on a standard typical single family home somewhere between 25% and 35% of your total purchase price segregated out, eligible for bonus depreciation. General rule of thumb, again, there's different facts and circumstances can change that greatly, but generally 25 to 35. So Kevin used $300,000 on $1 million property. We have a client that got 89% of his purchase price allocated to bonus depreciable property. He didn't spend $1 million on it, but if he had spent $1 million, that meant he got $890,000 of bonus depreciation. And he didn't have to get a cost segregation. Shouldn't have gotten a cost segregation. So what is it? How do you do this? Is it legal? Yes. As a matter of fact, it's also required. It's just no one practices it in the real estate business. Baffles me why, but that's what we do at Revo and at Hidden Money is we uncover these amazing opportunities. IRC 1060 requires, doesn't necessarily require it, it recommends, highly recommends it, and it provides how you should allocate a purchase price of a business. It says anytime you are buying or selling a business, a trade or business, you are supposed to determine between the buyer and the seller in an arm's length transaction. They are supposed to be unrelated. Neither of them can be under any undue influence. You can't hold a gun to someone's head and tell them to sign it. It won't qualify. But they're supposed to decide how much each of the component they're spending or selling it for. This really came up big time in the 80s, and that's when they started working on 1060 a lot. And that was when you normally buy or sell a business, you're selling maybe your assets. You're selling, sometimes it's a stock sale, but if you're doing an asset sale, you're selling assets. And generally the seller doesn't want to allocate his sales price to the fixed assets because of depreciation recapture, because of ordinary income, or because of hot assets. They'd rather it be allocated to something called intangible property, which always gets long-term capital gain treatment. That's goodwill, going concern value. And there was a lot of money business being played by taxpayers saying, oh, I sold $1 billion business and $980,000 was intangible. So the IRS wrote IRC 1060. They came up with methods on how you allocate it. But case law also shows if you have a willing buyer and willing seller engage in an arm's length transaction, meaning they're not related and they're willing to do this, they want to do this, they determine what they're paying or buying or selling, what the price is, what the fair market value is. That is the definition of fair market value, what a willing buyer and willing seller are willing to pay or sell these items for. For instance, let's say, go back to the taxi cab example. Let's say I buy a $20,000 taxi cab. I'm driving around for a couple months. I got to depreciate $20,000. Kevin comes up to me and says, hey, I like your taxi cab. I'll give you $100,000 for it. For my $20,000 taxi. First of all, you can have it, Kevin.
Okay.
Can we do this
deal?
What
a great deal for me.
Heck yeah, for me, definitely. But if Kevin truly paid that to me,
And we're independent. We're arm's length.
We're
We're
arm's
not
length.
related.
Right. And I'm not putting a gun to his head. Kevin can now take that $100,000 vehicle that I was only allowed to depreciate at $20,000. He can depreciate it for $100,000. It's law. It's tried and true. That's what fair market value is. So we apply Section 1060 to the purchase of real property trades or businesses. If you're buying a short-term rental, that's a real property trade or business. Apartment complex, that's a real property trade or business. Long-term rental, maybe so, maybe not. It gets a lot more murky in the detail facts. But you're buying a property, and you go and buy $1 million property, and you say to the willing seller, let's say this is just their primary residence, but you're going to use it as short-term rental. They never depreciated it. They don't have depreciation recapture. You say, and I'm going to crazy example. I'm going to use your example that I heard you telling a client the other day.
Okay.
The magic refrigerator. Yes. I like that. It's a good example. Yeah. The magic fridge. So I say, I'm buying your $1 million house that you're selling, but I want you to agree with me as part of our contract. We're going to do a purchase price allocation. I'm giving you $50,000 for the building, the land, everything else there. But that refrigerator is awesome, and I want you to sell it to me for $950,000. We have just created a purchase price allocation. Don't do that one, by the way.
Yes, don't do this.
But this is for example. We just created a purchase price allocation, and now I have paid $950,000 for refrigerator. That's 100% eligible for bonus depreciation. $50,000 for other stuff that has 27.5 year, 39 year, and 7 year, and 15 year. That's a purchase price allocation.
Yep, that's it in a nutshell. Now, the seller is going to kind of balk at this unless it's their primary residence. And we advise our clients that, hey, we can't advise the seller. And you can do a purchase price allocation on the sell side too. We'll get into that. But let's say right now we're doing the buy side. So if you're buying, you're going to go to that seller and ask for this purchase price allocation. That seller needs to hopefully have some sort of tax counsel in their corner. And then it becomes a negotiation. Like you're working one right now to where you're getting with the seller's CPA, trying to figure out, okay, how much more in tax are they paying with this allocation? Our buyer is actually going to kick in more cash to the deal to cover, because let's say the seller incurs $40,000 of additional tax. Our buyer, our client, is saving $500,000 in tax. So we're going to say, we'll pay the 40 grand. We'll up our sales price to cover the additional tax hit you're taking if you agree to this, because now I'm still saving $460,000 net at the end of it. Yeah. Both parties win. So you can see where it's a negotiation between the two. But where the stars really align is really in one of two ways. The seller on the buy side, the seller is primary residence, like you already said, under Section 121. If they've lived there for 2 or 5 years, they are not recognizing a tax up to $500K of gain. Now, the second one is that maybe the seller's doing a 1031 exchange. They're still going to track depreciation recapture, still tracking gain, but they're not going to pay tax on it then. Instead, they're going to defer it.
You're throwing a lot of tax code out there. So if the seller has not used the property they're selling in a trade or business, they're not subject to depreciation recapture.
Correct.
If they have used it in a trade or business and taken depreciation on it, they might be subject to depreciation recapture. If you do a 1031, that means he's doing like-kind exchange. You don't have to recognize a depreciation recapture, although it will follow them into a future sale if they ever actually have a taxable sale. So there are ways to mitigate it for the buyer and seller. But again, it's not an equal sum game. Like this current client I'm working with and their seller, who I hope to get on the phone with their CPA today, please. At worst case scenario, I haven't seen his details yet, but I suspect he has taken some bonus depreciation. He did something similar to a cost segregation. He's going to recognize depreciation recapture. But I think he's only going to pay an extra $30,000 or $40,000 in tax. If he will do what we're trying to get done for our client, the buyer, they're going to save $400,000 or $500,000. So again, it's not an equal sum game. And like Kevin said, fine, explain that to the CPA. Let the seller CPA double check your math and say, yeah, you're going to pay an extra $39,000 in tax if you do this. Cut him a check for 39, for 40, for 50, whatever.
Yeah,
Just
you're
cut the
saving
check.
more tax. And all this work, we represent our client on the buy side, and we'll get into the sell side here in a sec. On the buy side, we draft the language to put in the contract. We perform the allocation alongside our engineer. We have Internal Revenue Code citings and defense. If the selling CPA needs it, we'll work with them. So there's a lot of work involved with this, and it needs to be done all before you sign any paperwork,
Yes.
get into a contingency, before you get into any sort of option period on these rental properties. You need to say, I am going to remit an offer on this rental property. Here's my offer. You can let's say they're selling a $500,000 house. You could say, I'm going to offer you $500,000. And we're not going to do a purchase price. Or I'm going to give you $515,000 so long as it's contingent on us allocating the purchase price. You could do two kind of offers on the front end and let the seller choose, or just have a conversation with them. It's their primary residence. You don't need to kick in the extra. So this is all part of what we do on the buy side.
And the truth is, like, you had a client last week who was buying a primary or something, and there wasn't going to be any tax impact, but that seller went to their CPA, and the CPA was like, I'm scared. I don't know what this is. Kevin was sending them the tax code and trying to educate that CPA, and they didn't necessarily do it.
Yeah.
But it wasn't part of the original offer. So if you make it part of the original offer, great. The one I'm working with right now, he didn't know about a purchase price allocation, but he called me the day after he submitted his offer and was under contract. I was like, dude, let me tell you about this. He's like, no. And we're trying to negotiate it, and Lord willing, we'll get through it. You can do it, but in a perfect world, it's part of your original offer.
So there's three ways to depreciate a property. One is just the straight line, 27, 39 years. You'd be a good little taxpayer and you just deduct it over time. A better option is going to be cost segregation, to where we're actually pulling the values and putting them on the qualified improvement property or 5-year property and taking bonus depreciation on that. The best way to do this is the PPA. It's just you're not in control of it. You can't just say, yeah, I'm going to do a PPA. You got to have two parties agree on it. So there's some more hoops to jump through, but it's well worth it.
And don't just go out and do a PPA on your own. You can do that, but be very, very careful. And there's just a lot of I's to dot and T's to cross. So just be careful if you do one. Technically, if you do one, it might hold up, but it also might not. And there's compliance requirements, right? Filing in the right form on the buyer and seller's tax return. But that's how to potentially triple or quadruple your depreciation on an asset you go buy. So with a client, this specific example, a client's buying $1.4 million short-term rental. He's going to get about $400,000 bonus if we do the cost seg. If we get the PPA, I think we're going to get about $1.2 million. 3 times the amount of depreciation. This guy makes about just under $1 million a year. He's going to pay 0 tax for 1 year and only pay half the normal tax the following year.
It's a 2-year tax
It's covering his down payment and giving him a big old bonus to boot.
And let's get on the sell side, since we're running short on time, because this has all been you purchasing. Now, if you're selling a rental property and it's a trade or business property, at that point, then we can actually be a little bit more in the driver's seat as the seller, because you can accept offers from buyers. And if you're not in a rush and you're not underwater and trying to release this property real quick, you can go to the people submitting offers and be like, I'll accept your offer so long as you do a purchase price. You say no, I'm going to the next offer.
Yep.
So now we're more in the driver's seat, but now we can allocate, instead of allocating the purchase price to the magic fridge, where we're going to say, hey, this fridge is awesome and we're going to accelerate depreciation. We're going to take this purchase price allocation and I'm going to allocate, let's say I sell this rental property for $1 million. I'm going to allocate $950,000 to the brick, mortar, and roof, the actual structure, which is capital gain, then $50,000 to land.
Yeah.
And then at that point, everything's long-term capital gain. Even though maybe I got all the write-off on the front end, I'm not going to allocate any of my sales price to the actual zero basis tangible personal property.
Boom, no depreciation recapture. So not only did you get a whole lot of depreciation in the beginning, when you turn around and sold it, you don't have to recognize ordinary income, you can get all capital gain. Again, the examples we're using here are extreme, don't go do them. They probably wouldn't hold up under IRS audit, but you can do this and do it in a way where it will hold up in the IRS audit. So please, it's called a purchase price allocation, PPA. If you are planning on buying a property, real estate, or a business, any trade or business, consider it. Reach out to your tax advisor or your tax attorney or us before you make your offers and rock your world, man.
Yeah, it's huge ROI on it. If you go to revotaxpayer.com, that's our website, you can schedule a consultation with Mike or I. We do free consultations. If you're in real estate and you're about to buy or sell your next rental property fairly soon, reach out to us. Let's see if it's a good candidate. Let's see if we can't network with the other party and get this purchase price allocation done. But if you don't, we'll at least do a cost segregation and still structure your real estate transactions to be most tax advantageous product.
Cost segs are still good, man.
Oh yeah,
They're still
especially
very
with the
good.
100% bonus depreciation. Cost segs are tried and true. We've been doing them forever. But it's just this new one's really exciting. So thank you so much for listening to today's episode. Again, check out revotaxpayer.com or hiddenmoney.com, and we'll see you on the next episode.